Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Qualcomm are trading higher today. The smartphone chip designer is unveiling a $20 billion U.S. buyback program. The American company says this is in addition to its existing $2.1 billion share buyback plan. Qualcomm is among the largest smartphone chip providers in the world, but it has been increasingly diversifying its business to enter the data center chips and autonomous vehicle markets. The Canadian Real Estate Association says home sales continued moving at a slow pace in February, but activity started to pick up near the end of the month. Benchmark price of a home fell 0.6% from last month, and home sales were about 8% lower. However, a senior economist at the association says it expects pent-up demand from first-time buyers to translate into sales for 2026. Oil prices have rebounded after the first drop in almost a week. A large gas field in the United Arab Emirates was targeted, and a vital oil port was halted again. These incidents adding to a fast-growing list of energy assets across the Middle East that are being targeted by Iran. Meanwhile, the U.S. National Economic Council Director Kevin Hassett says more oil reserves could be released if needed. And taking a quick look at the markets right now, another green day for them. Everybody, for St. Patrick's Day, rather apropos, I guess. Second day in a row that they are up. TSX by 0.82%. And all the indices, except for one, consumer staples off slightly, but the rest are all up. Tech leading the way, up about 2.3% right now. South of the border, similar situation. Everybody in the green right now, up around 0.5 for the Dow Jones, 0.6 for the S&P 500, almost 0.7 for the Nasdaq. Well, the markets are up today as the rally in oil eases, but the oil is going up as well after those record highs, though not up there yet. Our next guest says the potential direction of oil prices presents a conundrum for central banks, which have to choose between fighting inflation or a weakening economy. Joining us now is Melissa Brown, Managing Director of Investment Decision Research at SimCore. Melissa, thanks very much for joining us.
Sure.
All right. Oil's back up again today, but not as much. It's kind of a little calmer. Is that a good sign? How do we interpret this?
I mean, I think oil prices are high in general. So, over $100 a barrel is still pretty high. And so I think on balance, it's negative. Higher oil prices are going to translate into higher prices for transportation, for goods, for many things for consumers. So I think the longer they stay high, the bigger impact oil prices will have on inflation.
If they were to hover around here, is that a manageable high? I mean, no, obviously everybody would love to see oil go down, except for people who own oil. Is that a manageable high, what we're at right now?
In general, prices staying stable are better than prices being very volatile, which is, clearly what we've seen here. I still think the oil price is a bit high, even if it doesn't go up anymore. This higher price, that's, only been higher for a few weeks, is going to take a while to wind its way through the economy. So by staying that high, I think eventually that's going to show up in the inflation numbers.
I mean, we are already seeing it. I filled up at the pump yesterday. I have to put premium in my car, and it was $2.05 a liter. I haven't seen that, I guess, probably since, 2022?
I mean, I can remember the gas lines in the 1970s, just to give away my age a little bit. But so I guess everything is always relative. But yeah, for sure, I think, as people go to fill up their tanks and then realize, okay, maybe they have to trade down on some other goods. I think that's where it starts to impact the economy as a whole. Even if it were just limited to higher prices at the gas tank, I think that would still be a problem. But I think it actually goes way beyond just that.
And how does this compare to the oil shock of 73 probably is the epitome of an oil shock. How does it compare to that? And I'm sure your parents were driving and you were sitting in the back of the station wagon in the back with no seatbelt probably, right?
That's it. I was still in my baby seat, but well, I don't know the exact prices. Obviously, things were much worse then with people having to line up and, go get gas on alternate days and, all sorts of things that, again, had a ripple effect because if you were waiting online for gas, you weren't working. So, certainly we're not anywhere near that right now. I think, we're well away from that. But, it's something that I keep in the back of my mind as, probably an extreme potential, but, not a zero chance of it happening.
And it's interesting. I mean, the markets are in a bit of a rally over the last couple of days, kind of going counter. I mean, when we saw oil go up, we saw the markets go down. But to the last couple of days, the markets are going up. Any particular reason? Are you seeing why investors are reacting the way they are?
I think the sentiment for quite a while now has been to buy the dip. And so we had a dip. And I think the investors have just been conditioned to come in, buy that dip, maybe be a little more specific. So, if they're buying more of the technology type names, for example, they obviously still see an upside there. But I would say that, investor sentiment remains fairly negative across the world. And what that means is that while investors may be buying, they are, buying lower volatility, names that are perceived to be safer, as opposed to, really going out there and loading up on risk in their portfolios. It's also been interesting that we've seen the trading volume is way down in the U.S. So investors do seem to be sitting on their hands more in the U.S. than elsewhere. Trading volume in Canada is at its at least 1 year peak as of a couple of days ago. So I think we're seeing kind of a differential reaction around the world.
All right, and then in Canada we can throw in we can probably throw it in the States, some weak job numbers. Housing market is soft. Where does this leave the Bank of Canada and the Fed?
I think it's really a conundrum for them because, with dual mandates to fight inflation and to, maintain a strong economy, it is, I think it's a very difficult decision for the central banks at this point. And I think that most likely means that they won't do anything for now because certainly the Fed is going to want to wait until they see more evidence. They're so data driven, so they want to see that evidence one way or another. But until then, they probably won't do anything. It's been interesting because it's been a long time since we've heard about potential rate hikes. Mm-hmm. And then all of a sudden, that seems to have entered the conversation.
Yeah, the possibility. I mean, there's been talk of 2 maybe this year for BOC and the Fed. I'm not sure I haven't seen where the latest on the Fed.
I think that it's still, kind of relatively low probability, but it was 0, a month ago. So that possibility does exist. Again, depending on going back to the oil price discussion, if we start to see those inflation numbers tick up, the Fed is likely going to act.
Okay, we'll leave it there. Melissa, thanks very much for joining us.
Thank you.
Melissa Brown is Managing Director of Investment Decision Research at SimCorp. Up next, Eli Lilly is slipping as it gets its first sell recommendation. We'll find out why after this. Lemonade continues to rise after Morgan Stanley upgraded the stock to overweight, citing its early advantage in the shift toward autonomous vehicle insurance. We asked our guest earlier today, Peter Hodson, Chief Investment Officer and President at Eye-to-Eye Capital Management, for his thoughts on the autonomous market.
Certainly, the autonomous market has to improve, and we have to get more sort of government official recommendations. I mean, everyone gets concerned if there's a death from an autonomous driver, but obviously it's way less than everybody else is driving.
Well, I mean, there's not many on the road right now, too.
And
I'd love to see the miles driven and see how they stack up.
Yeah, I think the technology's close enough, but you really have to sort of execute it properly. Like one thing that people are throwing out is like make all trucks autonomous. So now everybody knows that the truck is autonomous, and you know exactly what it's going to do, as opposed to, is that Honda autonomous or is that one autonomous? So that, I think, is important. But in terms of future development, I mean, we're still in transition. We have no idea how it's going to turn out. We don't know who the winners are going to be. EV does not look to be the greatest solution in terms of sales. Anyway, the sales are not doing as well as people thought. You've got, massive developments in AI, which I think will push the autonomous thing forward. And companies like Lemonade, they apparently offer a 50% discount to any full autonomous Tesla that they insure. So obviously you might get actual savings. I'm not going to say your insurance rates are going to go down, because that'd be crazy. But maybe the insurance company's profits will go up. But again, just like the economy and housing, the car market, is not exactly booming right now.
All right, and that was Peter Hodson, Chief Investment Officer and President of Eye-to-Eye Capital Management. We're talking about autonomous markets and their insurance as well. Coming up, today's market driver is with Bloomberg's Monique Malima. Earlier on the radar, we sat down with Peter Hodson, Chief Investment Officer and President of Eye-to-Eye Capital Management, to discuss a few stocks that are on his radar. We kick things off with a polarizing one, AppLovin.
AppLovin has a 61% net margin on everything it sells. Their growth rate is in the 65 to 70% range. It's a $100+ billion market cap company. It's down this year, but I think it's tripled in the past couple of years. So AppLovin is a digital advertising company that allows advertisers to pick their spots. So for example, if there's a TV show that's got a Hallmark movie and it's very sad and everybody's depressed, they'll put in an advertisement for tissues. I mean, that's the simplest example, but that's exactly how it works. But it's all self-run by the advertisers. So the company does not have a lot of employees. They're actually very, very lean. They make a ton of cash flow, and they're doing very well. But the thing is, half of Wall Street thinks it's the greatest company they've ever seen. Massive margins, massive cash flow, not hiring people, and massive growth. It's a great combination. The other half of Wall Street thinks it's a giant scam. And there's been 6 or 7 very vicious short attacks on the company, saying it's a money laundering company. They're cheating in terms of using Google and Meta's input. And so the stock is just exceptionally volatile. And here's a very simplistic viewpoint. If it were a scam, you would not give it such a stupid name.
Well, you never know. Maybe that's the brilliance.
Maybe
it's
brilliant. But the growth is there. The valuation is much more reasonable now. But it's really just net margins. And people are saying, how do you do it? And how do you do it? So they took a big hit this year. It's down about 36% on the software scare, and AI is going to kill everything. But they actually utilize AI to help their advertisers, and they've done a very, very good job. Now, whenever you get a company with high margin, high growth, you do get competition. So there is competition, and this is perhaps the short sellers are trying to sort of attack it in terms of what the problem is.
Okay, have any of these accusations stuck against it?
No, not at all. I mean, the company, if they were cheating on Google and Meta, Google would know about it.
I think so, yeah.
Money laundering for a $100 billion company just makes no sense whatsoever. Yeah. And again, but you've got this stock that's gone from $80 to $500, and so a short report comes out. It goes down to 400 because everybody's made a lot of money on it over the past 3 years. So it is a very polarizing company. And every day you don't know whether it's going to go up $100 or down $100. But the actual fundamental numbers, if you look at it, are very, very impressive in terms of its return on equity, and its efficiency is just quite amazing. So, it's not a stock that everyone should own, absolutely, but it's very interesting, I find, because of that massive fight between the two. Because usually analysts are just, they say everybody loves it or everybody hates it. And now it's just this massive fight.
Oh, all right. So it's a real stock then.
Yeah.
Some people love, some people hate. Hydrograph Clean Power.
Yes. So first, I want everybody at home to say this is not a recommendation. This is a discussion. So here's a company that is involved with graphene. I'm not a graphene expert, but graphene has multiple uses. Electronics, batteries, composites.
And this isn't the same that's in your pencil, like when you're reading it.
No, it's the little
drawing.
hexagons. So it's a situation where this company is being very heavily promoted, and it had a 2.7 billion market cap last week. It's down 36% in the past week. It's very, very volatile. But it's up 2,500% in the past year. And it's just exploded in terms of investors trying to get the FOMO trade because it keeps going up and up and up and up. So I don't want to diss it, but I don't want to endorse it because it only has $20 or $30 million in assets for a $2.5 billion company.
Wow.
So I want people just to be aware of the risk here. There's a lot of expectations that they're going to have huge margins and huge contracts, and there is potential. But it's a stock that went down almost 40% in a week. And if you're a conservative investor, you might not be able to handle that. So I don't know what's going to happen. They're in sort of pilot scale right now. And a lot of times when you go to commercial scale, things aren't quite as good when you ramp up. Again, I don't know what's going to happen, but I just find it very, very interesting that you've got this massive market cap trading on the Canadian Securities Exchange. And everybody loves it, but the financials are not quite there yet.
Okay, well, keep an eye on it. Last one, Micron.
Sure.
And not the hockey skates from the 70s. I love it. Every time I think of Micron, that's what I think of.
The Micron is a DRAM memory producer. It's a $500 billion company now. And what's happening is AI is taking all the memory away from everybody else. And so the price of computers is going up because Micron has actually said they want to focus on the data center market and the AI market. And why not? Because these guys will pay whatever it takes to get memory. So an absolute shortage of supply, and Micron and a couple of other companies, not that many, a handful of companies, have the ability to raise prices almost at will. They're sold out for more than a year. And here's the interesting part about the stock. Excuse me. It's trading at 11 times earnings because in past cycles, it's been very, very volatile. And what happens is the price goes up and production goes up, and then demand stops, and you get a total collapse. But that's changed a little bit by AI because the discipline of the industry is much higher right now because there's been a lot of consolidation. So there's fewer companies, they're sold out, and their addition of capacity is much lower than other cycles. And at the same time, because they're making so much money, their balance sheet, like the energy companies, is so much better. So in the downturn, whenever it happens, the floor will be much higher than before. But meanwhile, they're just coining it. I mean, their earnings are going from 70 cents a couple of years ago to $20, $30, and $50 forecast. Like it's just, if a hockey stick from the Micron, if you're a hockey player, the hockey stick is just ramping up right now. But it's the valuation. 11 times earnings is ridiculous. Even if the cycle ended tomorrow, it's still kind of a good valuation for the long term.
And that was Peter Hansen, Chief Investment Officer and President at Eye2Eye Capital Management. Time now to take a look at some of today's market movers, and we're joined by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us. First up, Canadian Solar getting a bit of a bump. The sun is rising for them, I guess.
Yes, so Canadian Solar, they are up today after Mizuho upgraded the stock. The stock's been really underperforming recently. They have operations both in China and the U.S., and the U.S. put in place some stricter rules at the end of last year related to operations in China when it comes to the solar industry. So the stock's really been taking a hit because of that. But analysts today are saying that the decline in the stock is now overdone. They think that there's upside ahead for the company. The company's looking to open a factory and purchase a factory in the U.S., and this would help them to be able to meet some of the requirements to get U.S. tax credits for their production. So this would help the company in terms of the tax credit benefit, in terms of meeting the demand for domestic manufacturing for solar panels in the U.S. So they really see the opportunities for growth going ahead now that they've kind of gotten past the biggest hurdle in terms of moving away from some of their operations in China.
All right, I just saw they just signed a new deal with a U.S. Utility for data storage centers, energy storage on their DC battery energy storage system. So see some more money coming in for them. Let's talk nuclear now. Oklo, it's rising.
Yes, so Oklo, their shares are rising today after they got approval from the U.S. Department of Energy for their safety design for their small modular reactor. This helps to advance the progression for the small modular reactor. It would be the first one in the U.S. It's currently being worked on in Idaho, and this is just helping the company move closer and closer to being operational and also being able to actually have revenue coming in. Currently, they don't have any reactors in operation, so this is something analysts have been seeing for a while. This is another step along the journey, and it's helping them get closer to having that up and running, and it would also put them as a leader in this space as they continue through this process. So this is something that people are seeing as really positive.
All right, and Diamondback getting named a top pick at Mizuho. What's it doing right?
Yes, so they were named a top pick. Their shares have been rising with a lot of the other energy names as oil prices have been rising due to the conflict in Iran. And their analysts are saying that they are going to benefit from the rising oil prices. That will be able to help increase their free cash flow in the near term. So that's a boost for the company. But they also see some more fundamental things for Diamondback. The shares haven't performed as well as some of their peers, even though Diamondback's production rates per foot are actually higher than some of its peers, and it is starting to show more improvements in terms of its earnings and its debt levels. So they see some upside ahead, and they also are particularly looking for companies where there still is more room to go for the shares. Some of the energy companies have seen large gains recently, and they say this is one that hasn't seen that same level, but can see that level and potentially more going forward.
All right, we'll wrap it up there. But Monique, thanks as always for joining us. Bloomberg's Monique Molima. Well, shares of Eli Lilly are seeing some pressure today. The stock has been cut to reduce from hold, and HSBC says the stock is not attractive, especially given uncertainties surrounding the future growth of its obesity drug franchise. Let's get more from Rajesh Kumar, head of European Life Sciences and Healthcare Equity Research at HSBC. And Rajesh, thanks very much for joining us. What has you worried about Eli Lilly right now?
See, so far, if you think of the company, execution has been fantastic and growth has been absolutely stunning. The company's guidance for the year seems to be diametrically opposite to its key competitor, Novo Nordisk, and that boils down to the execution in the cash market. That said, the problem you've got is the market has sort of got overexcited about the oral drug launch. If I look at what people are penciling in for orforglipron launch, maybe in second quarter, end of second quarter, beginning of third quarter, whenever it happens, people are already penciling in $1.5 billion of revenue. So some of the estimates are there. And, there's a potential for disappointment because, you and I very well know that compliance and persistence on orals can be potentially lower than on injectables. So, it sort of is a risk to the way the street is thinking about this. In the medium term, you've got another problem coming up that Novo is losing market share and prices are coming down. So, there's a slight risk that the pricing environment might not be supportive. And, if I look a bit further out, we've got 4 markets where, Wegovy, Ozempic generics are coming today, and those markets pricing is collapsing for anti-obesity drugs, potentially. And then if that were to happen in 2032. So at this junction, people are sort of penciling in, stairway to heaven kind of growth in Lilly and a complete collapse at Novo. But sort of the market is joined at the hip, and that seems to be missing from the market's thinking.
I just want to go back to the oral and the injection and the compliance. How different are the two? What's the different rates?
I mean, think about it in a very simple way. Typically, you have to take a pill every morning, right? Mm-hmm. Versus, you take a weekly injection, which you sort of plan around. If you have a traveling job, if you, even best of us forget our vitamin Ds in the morning when we know it's so good for us, right? So, what sort of compliance you manage to get from an oral, you need to think about that when you're building your forecast. But then also you need to think about, the clinical trial data, the tolerability we have seen for, the orals has not been as good as for the injectables to some extent. It depends on which drug you're looking at. But if you are not sticking to the dose, if you're not getting the weight loss you thought, or you're not maintaining weight loss, you think, oh, it doesn't work. Or how many people drop off? We don't know the answers to that. But the previous version of an oral drug in the space was Rybelsus. Okay, very different product. It has got a food and water restriction, but the persistence of treatment there has not been great. So, without any other data at this junction, I'm not really going to say that you need to really model this completely different compared to the history we have in the space.
What would make you change your mind on this?
I think it's a great company. The thing is, the execution is great, growth is great. You need some confidence on what happens to the cash channel if if you think AI is going to eat into a white collar labor market demand. How many people paying out of pocket will continue to pay out of pocket for these drugs? Maybe the lower prices might help. You also need to think of a sensible valuation. And then if the valuation is sensible and Street is not, competing to put the highest estimate out there for Orpho, the execution story is quite attractive.
Okay, we'll have to wrap it up there, Rajesh, but thank you very much for joining us.
Welcome. Thanks.
Rajesh Kumar is head of European Life Sciences and Healthcare Equity Research at HSBC. Coming up, a new poll from RBC shows that despite ongoing market uncertainty, Canadians still hold on to the dream of home ownership. We'll have more on that after this. Shares of Nebius are plummeting today. The AI infrastructure company is aiming to raise $3.75 billion US through a convertible loan offering. The Dutch-based company says it intends to use the funds to finance business growth by building data centers and buying chips. Earlier this month, Nebius struck an AI computing deal with Meta and secured a $2 billion US investment from NVIDIA. The Bank of Montreal plans to open more than 130 financial centers in California and about 15 in Arizona over the next 5 years. The bank is looking to expand its presence in the U.S. West after the sale of several branches across the nation last year. The lender says the expansion will create hundreds of jobs and enhance access to in-person and advice-led banking. Shares of Delta are up today, about 4.5% right now. The American company is issuing a more optimistic sales target for the first quarter despite rising oil prices. The upbeat outlook is attributed to accelerated bookings by leisure and corporate customers in March. The airlines company says corporate demand will likely stay strong if prices remain elevated during the next 2 months. Delta's earnings will remain within the initial guidance. And taking a look at the markets right now, you can see still green. Yeah, the TSX up by about a half point. And south of the border, let's see if it's holding still. Ooh, it's holding but slipping. They are still in the green, but only up now by 0.29 for the S&P 500, 0.27 for the Dow, 0.25 for the NASDAQ. So they have lost some ground as we get the day going. A new poll from RBC says 2/3 of Canadians still dream of owning a home, but many remain hesitant to take the leap. For more insight, I'm joined by Janet Boyle, Senior Vice President of Home Equity Finance at RBC. Janet, thanks very much for joining us.
Thanks for having me, Roger.
Well, I guess the hope of owning a home is growing, is it not?
I think despite waking up to snow in Toronto today, the spring market is upon us. And I think what our poll shows is that Canadians have not given up on the dream of home ownership. I think they're just being a little more mindful and approaching it in a cautious fashion. So our results indicate that almost 67% still feel that buying a home is well part of their future dreams. And that's actually up from last year. So I think that kind of increase in confidence and expectancy, I think, from the home buying population is really, really encouraging as we enter into the spring market in what has been a pretty kind of challenging set of headlines coming out of real estate.
I was going to say that, and just challenging in general. I mean, we have the questions on the concerns about the economy, concerns about mortgage rates, what's going on in the world right now. Do people say what gives them that optimism? And do you know why more people think they'll be able to own a home?
I think what's changed, Roger, is just really their mindset, right? They've moved from this fear of missing out and having to rush in to really taking a thoughtful and measured approach around when the time is right, making sure that they are savings. We saw a really strong response in terms of the amount of savings that first-time homebuyers are putting aside. And they still feel that it's part of kind of demonstrating that financial responsibility or financial independence. We saw that almost 73% felt that owning a home demonstrates a strong amount of financial independence. And so I think that continues to go along with this narrative of saying, I'm ready to enter the market. I want to do so with the right advice at the right time and putting together the right amount of savings. So I think there's a lot of these levers that are coming together to support that level of home buyer confidence.
And the young people, I mean, we've talked about the younger generation, the Gen Z's just saying we're never going to own a house. Do they have optimism about this? Yes, they think they actually they might be able to buy a house.
Like those first-time home buyers, our numbers were showing 62% actually feel that they are closer to their dream of owning a home today. And I think that's a really strong number that suggests a high degree of confidence in terms of their ability to enter the market. So I think in spite of some of the other headlines that we've heard, we are continuing to see prices moderate. I'm not looking into the crystal ball, but certainly lots of experts that you've had on the show suggest no rate increase or decrease by the Bank of Canada upcoming. And so this continues to suggest that for those who are ready to make their first home purchase, it is a good time to be thinking about a spring purchase in this market.
And we've talked about, and I mean, the numbers just came out today. Sales were down, average price is down for a home. I mean, for some people that's bad news, but for other people who are looking for a house, that's good news, isn't it?
It is, and I think even if you look at a next-time home buyer, what you'll see is 75% of people from our poll indicated that they felt that owning a home was still a very, very good investment. So very, very strong sentiment from those who are current homeowners. And of course, we know that next-time home buyers also make up an important part of the spring market. So not just first-time home buyers will be out there this year. We also think that there'll be a number of next-time home buyers that are looking for a new property, either in terms of expanding or other types of lifestyle changes. So I think that's the other factor in play, that those buyers continue to feel that their home has been a very good and solid part of their investment strategy.
And I mean, we're also seeing the provinces looking into this. We're hearing from Ontario that they may drop the HST on new homes, which is another incentive that may draw more people in.
Yeah, I think there's no shortage, I think, of options in terms of different experts weighing in on what we need to do to support, a more robust home ownership strategy. I think certainly that support of various levels of government around taxation and levies and things like that always goes a long way in terms of contributing to just making that affordability more within reach for more people.
And now you talk to people who want to buy, but also people who have homes already, and mortgage renewals are front and center for them.
Yes. So I think when people are thinking about renewals, they want to make sure that they're getting good advice, strong strategies around do they want to go fixed or variable? And I think what we're seeing is a lot of great opportunities for certainly banks like RBC to be reaching out to clients with a very strong set of advice tools around what they want to be thinking about as that renewal comes up, and being very proactive and investing the time and having a really rich and fulsome conversation around what their options are and what's the best opportunity, product, and program for them to enter into as they're thinking about that mortgage renewal.
All right, Janet, thanks very much for joining us today. We appreciate it.
Thank you, Roger.
Janet Boyle is Senior Vice President of Home Equity Finance at RBC. Coming up, we'll look at the stocks on the TSX, the one stock that is up almost 70% since the start of the year. Stay with us. Well, shares of 5N Plus are up sharply since the start of 2026, rising almost 70% since the beginning of January. Here to tell us what's driving these gains and if we can expect the momentum to continue is Amer Ezzat, Managing Director and Deputy Head Research at Ventum Capital Markets. And Amer, thank you very much for joining us.
Thanks for having me, Roger.
That's it's quite the meteoric. I guess we can use that term, meteoric rise for it. What's driving this?
What's driving it isn't really a single quarter. I think a lot of it is a shift on how investors understand the business. A year ago, I would say 5N Plus was perceived as a cyclical specialty metal company. Today, investors are increasingly seeing it as a supplier of mission-critical materials into long-cycle growth markets like solar and space. As that perception changes, that helped the stock re-rates. The other thing that helped is the markets that they supply into, being solar, so that is power, space, and military, are all experiencing structural tailwinds, which gives 5N a lot of visibility.
I know you have the Canadian government upping its spending on defense, and I mean, everybody is talking about space right now. Is there any concerns though that bigger semiconductor companies like Taiwan can come into this area and push them out?
No, actually, what they do is extremely specialized, and in every market, there's only one or two players who could actually supply the compounds. They're real like moats, and like the high barriers to entry in this model is their integration. They start by sourcing very complex feedstock, things that most companies can't process. Then through the feedstock, they extract metals like cadmium and germanium. Then they refine those materials to very high purity, which as well isn't a very easy process to replicate. Then finally, they convert them into finished compounds used in solar and space. Let me give you a couple of examples. They are the key supplier to First Solar in thin film solar. That is the one mission critical component of the product. And there are only two players in the world able to supply that compound. Then in space, through their Azure business, they supply solar cells used in satellites. And these aren't commoditized products. They're highly engineered materials with very high barriers to entry. And once you're engineered in, it's nearly impossible to replace you.
And so where are they looking to grow? Are they strictly Canadian or are they marketing around the world?
Actually, most of their sales are outside of Canada, in the US, for the most part, but they do have also a very big presence in Europe.
And any concerns with the U.S. with CUSMA, the negotiations, and just the whole trade war that's going on?
Zero. They actually have like lots of their plants in the U.S. and they were recently awarded by the Department of Defense, or now the Department of War, I should say, a contract to supply the U.S. military with germanium. So germanium is used like for things like infrared optics, thermal imaging sensors, and again, certain space and satellite applications. And these guys are actually supplying the U.S. military, so we don't foresee any risk there.
Do you see any potential? I mean, it almost sounds too good to be true. Do you see any potential headwinds for this right now?
There are always risks, don't get me wrong. Input costs, execution, margin normalization after a very strong 2025. But what's important is demand is not the risk here. And a lot of the market is starting to realize that. The core business being solar and space, then the emerging business being military, remain extremely strong and largely contracted for the foreseeable future.
And any concerns about supply sources being cut off?
They haven't had like issues thus far, and there was a lot of concern last year of that, and they've managed like extremely well through it because they supply from different areas around the world.
Where are some of the areas?
Mostly actually in Canada, the US, and in Europe. And there was a perception that they do actually get a lot of their supply from China, and that put a lot of pressure on the stock last year, but they barely get any supply from China.
All right, and I just saw they're getting a new board member. Any concerns or any reasons on the change, or just the original Jean-Marie Bourassa had been on there for almost 20 years?
Jean-Marie Bourassa has been there since the IPO, actually 19 years, and it was widely expected that he would step down. He sold a lot of his stock recently, actually. And the new addition that they have is extremely competent, so no real risks there.
All right. Amr, thank you very much for joining us today.
Thanks for having me, Roger.
We appreciate it. And that was Amr Azat, Managing Director and Deputy Head Research at Ventum Capital Markets. Up next, we'll give you the latest market update and some notable movers.
By lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them?
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Market Call is coming up next, and today on the show we have Christine Poole. She is President and Co-Chief Investment Officer at Davis Ray, and we'll be taking your questions on North American large caps. All right, let's see how the markets are doing right now. They're holding on. The TSX earlier this morning was up at about 1%. Now it's up by about 0.34, but second day of a little mini rally. We'll see what happens with it. Some of the movers we want to take a look at right now. We will start off with, I'm just going to get caught up here, and let's take a first look at Lemonade. We're going to go over to New York for a second, and Lemonade is the autonomous cars insurance, and it's up 14.89% right now, and it was having a good day. I got to learn to spell here. You can hear my typing. I got silent typing fingers there as we type. Just taking a look at this. It's up. Morgan Stanley upgrades it on a first mover advantage. So we're seeing a nice little jump for them. And elsewhere here on Wall Street, we're going to go back. Delta Air, they've been taking a lot of airlines, of course, been taking a hit. And I think people are just buying on this, taking a little advantage of that dip and buying Delta Airlines. Maybe they think things are stabilizing in the Middle East. So Delta is up right now. And one other we want to talk about, we were talking about it earlier, Eli Lilly. It has had downgrade. It had a sell right now, and it is taking a hit today. You can see it's off by, look at that, almost 5%, 4.85% on that announcement. So it's taking a little bit of a hit today for everything else on the markets, because the New York markets, also like Toronto, they are up right now. And Lululemon, they are reporting today. And I want to get to them and take a look and see how they're doing. Let's have a look here. They're up 1.41%. It'll be interesting to see. They've been struggling. It's bit of a soap opera unfolding there. So it'll be interesting to see what numbers they produce for today. And one other one we're going to bring up. We were talking about Delta. Let's bring another Canadian one up in Air Canada. And I think they're getting that same feel right now. They're the leading one, actually, leading mover right now on the TSX. And they are up by, what are they at now? 4.25%, 4.3%. I think people just taking advantage of the hit they've been going through lately. And overall, let's take a quick look at the American markets very quickly, see what they're doing, see if they're matching the TSX. Yeah, they've been slowly slipping a little bit. They're still on the green side. Oil, want to sneak through that quickly. And it dipped yesterday. And yeah, you can see it's back up about 2% today. And that is it for Morning Markets. Thanks for joining us. We'll see you back here tomorrow.